Good morning, ladies and gentlemen. This is Clueless 8, and this is the pre-market AM report for August 10th, being delivered at around 8:40 a.m. Eastern Standard Time, New York time. Let's get straight to the charts here. We have a pretty sizable futures open this morning. Futures are up roughly a little shy of 14 points. We all know, just want to give a quick market background here, that we have undergone a significant amount of volatility over the past week or so. The market's been down 7 days in a row. Not that it really matters, but the reality is that you are due for a retracement or reflex, a reset bounce, and that simply means that things got pretty damn oversold, and you're going to see some short covering and some and a bit of a short squeeze that's taking place right now. Now, taking a look at the E-minis right behind you right now, you can clearly see here. Let me point out a couple of very important levels as well as some of the internals, so all of you can basically guide yourself with the help of my charts that are constantly delivered during the trading day to make a determination of whether or not the trades that you're taking, the investments that you're making, are worth the money. So first of all, you take a good look at this very powerful uptrend line that is that starts off from the pivotal low that I use for now, which was middle of October 2014. People who have been following my work and people who are focused, members who have taken advanced coaching sessions know very well the power of this particular uptrend line. So this cluster, I call them volatility clusters. When you see this volatility cluster here, that's the Greek drama that was being played out in the first week at the end of June, and the first part of July. Okay, and that resolved to the upside. We were participants in this rally, and of course there were quite a few internals that I showed very clearly, which showed that we were going to break to the upside. Whichever the case, volatility clusters, as the term indicates by the nature of the beast, means that it is confusing. It is extremely mentally what should I say, debilitating for active traders. But with the help of all the Clueless 8 charts that are produced, as well as the commentary, you basically can manage the trades very well. Throughout this volatility cluster, we still made a decent sum of money, and as we are entering a reflex bounce here, I believe that we should be able to do the same. Now, uptrend line, it bounced off exactly off that. Let me just zoom in and show you right there. This line was drawn weeks ago, back here, and as you can clearly see here, it's no magic that it touched it exactly to the decimal point and then bounced. We also have this yellow line here, which is the 200-day moving average. Now keep in mind we're looking at the dailies, so the 200-day moving average is washed by the technical gurus and people who follow the market. In my opinion, it's a very overused moving average, but whichever the case, you get a technical bounce off that because everybody's kind of watching it, and it's considered that if you fall below the 200-day moving average, the world is over, and all that type of stuff. We have fallen, as you can clearly see here, at the first part of July. We fell below the 200-day moving average. Internals were suggesting, as I'm going to show you in a few minutes, that the market was going to basically bounce back beyond that and move further. This was a pretty powerful, not pretty, very, very powerful bounce that took a lot of people by surprise, including myself. But then, things like this happen. The volatility algos and the high frequency trading programs that dominate in the market, as I've said a million times, compress things which would normally happen happen in months. Now it happens in hours. So get used to the new reality because that's just the norm. Now, I've also mentioned one other thing which is extremely important, which that a good portion of the pressure that came last week was institutional, forced, I should say, institutional margin sell-off that came about because of oil and the commodity and gold collapse. When you have that type of sharp drawdown in oil prices and commodity prices across the board, you're going to see some significant large hedge funds get hurt. So when they get hurt, they go ahead and are forced to sell. Um, and that causes a ripple effect across the board, which affects other industries, other sectors, um, which which are sold in order to come up with the money to pay for the margin calls. It's actually pretty easy to understand if you look at, if you look at it from a simplistic way. Sometimes it's good to look at the market in a very simple way. So technicals and all that follow, and the media comes in and tells you all kinds of stuff about the U.S. economy going into a recession. I mean, that was the most hilarious thing that I heard. I could be dead wrong and look like an idiot, but then I'm clueless eight, right? But in my estimation, and I'm a pretty avid student of the global markets and the U.S. financial markets, I really do not see where we are in a recessionary phase here. Just because oil's down doesn't mean we're going into recession. We saw what happened in China. We had horrific numbers on their side. They targeted their infrastructure again, as in from a stimulus standpoint, and the Shanghai market was up 5%. So if somebody was going by the headlines and looked at the numbers that were released late on Friday evening, um, or Saturday, I think it was Friday evening, and the numbers when I tweeted that out, that didn't mean that the Chinese market was going to collapse. In fact, that's used as that's looked on, because the market is a forward-looking mechanism, that the Chinese authorities are going to be more aggressive with their stimulative effects, and over the short term, the market, that the markets are going to like it, and that's exactly what happened. The Shanghai market was up 5%. So that's pretty big. So I don't want to get into a global commentary on macro global game theory commentary on China and stuff, but I will tell you that regardless of what's going on there, as in the economic numbers, it is a controlled capitalist economy, and they will not let their economy fail and have billions of people. I can't even. I stopped counting a couple of years ago, but all kidding aside, but I think there's like the what 2+ billion people, or getting close there, to go out there and riot and burn down buildings and stuff. So they'll do whatever it takes to prop up their economy, and the global economy is not going into excuse my French, a crapper, just because of China's weak economic numbers. So saying all that, let's see what's going on here. We have a sharp bounce off the uptrend line. We have a we started seeing that on Friday, and we saw that reversal candle here. Let me zoom in. You saw that reversal candle here. This reversal candle, like I said, it really doesn't mean much, because we could very easily come down and test the lower end of the Darvas at 2056. But this is what's going on. We held the 200-day, and now we're moving up. Now here's the downtrend line here from the highs of 2126. Now that's not the S&P. That's the E-minis. So the S&Ps would translate into around 2134 or so at this level. You have to add like anywhere from 7 to 9 points to the E-minis to arrive at the S&P, as an actual S&P numbers. Anyway, so what we have here is somewhat of a dragon bullish pattern. People who have taken advanced coaching sessions are familiar with that term, and let me show you what I'm talking about. So we have a, and this is also a market structure low, and so we keep it, if the simplest way of looking at it is, we have higher lows. Okay, we have higher lows, and at this point, what we're seeing here is a very large bullish engulfing candle, at least on the future side. Now, if this candle gets extinguished and that becomes a fat red candle during the day, I can assure you that we're going to break the uptrend line and hit 2056, which would be around 2060, 2064 on the S&P 500. And keep in mind, these are the acceleration bands, and the lower end of the acceleration band is around 2048. That translates into about 2054 or 2056 on the S&P 500. So all these are in play, but at least we got to take what we see in front of us right now. And this type of very powerful futures move is indicating that some of the fast money is covering the shorts, and more importantly, they're buying in. All right. So from a standpoint of chart patterns, you could look at this as a dragon bullish or market structure low, which means that we're going to basically bounce. Now, where can we bounce? Do we bounce all the way up here and test the highs? That's very possible. We had a pretty dramatic sell-off. It can happen. But whatever happens, most importantly, we have to breach the downtrend line. This is a powerful downtrend line, and we are above the 50 and the 30. We are approaching this orange line right here is the 34-day moving average, and then you have the 50-day moving average. So this is a 50-day moving average. This is a 34-day moving average. So bottom line is that we have slightly crossed over the 34-day, and we're heading towards the downtrend line above the 50-day moving average. Once we cross that, obviously things go ballistic. The dogmatic shorts start covering, and we have this type of situation that occurs, right? We get up here. Now, once we get up here to the previous highs, let me get these lines out of here. Once we get up to these highs here, which is I believe in the 2107, which comes to about 2113 or so on the S&P 500, right there. There you go. All right. Um, if we fail, then it's going to be, back to the same old game. We're going to come down, and we are most probably going to test this extended uptrend line. We break that, we're going to be back to the lower end of the Darvas, and then of course we have the lower end of the arm of the acceleration band. So all those levels are still in play. However, at this point, it looks very likely. And I'll show you in the internals that we're going to move up and at least test that 2113 or so level up here. I'm kind of guessing the numbers, looking at that. If we break that, then we're going to complete this pattern symmetry right there, 2126. This is a bit of an outlier. Whether we get there or not, I don't know. But this is a very strong possibility as we get ahead towards the end of the month. Now, keep in mind, this is the middle of the month, and there's a lot of volatility. We all know that give or take a day or two, around the 15th of each month, we get very sharp pullbacks. So again, I'm just showing you the roadmap. So when my charts are hitting the Twitter feed, you guys have some sort of idea what I'm talking about, which you guys should have anyway, given the fact that I make my charts pretty clear to understand. Now, let's look at the internals here. We had large capitulated bars here, just the way similar to what we had here. So these are basically large institutional margin sell-offs. And David Einhorn's hedge fund, blew up on the gold side. I believe the fund was down -6% for the month. Then you had Andy Hall, who's the oil god. They call him the oil god, the biggest oil trader in the world. Andy Hall, his fund was down -15%, -15%. So there's a lot of stuff that got hit, and so obviously there was a lot of peripheral selling. Now, looking at the internals here, look what we're seeing. We hit a let me try to cover this quickly. We hit a pivotal low. Anytime you go below 20, RSI, you start to look at buying opportunities. It's just the way it happens. Now, this was an extended volatility cluster, so we made a double bottom. Double bottoms are fantastic. So we don't have a double bottom here yet. We could have a double bottom. That would confirm that we're really going to make a big move up. At this point, we're doing this. Is it possible that we get up and get overbought again? Yes, it is. Is it possible that we go up a little bit and then pull back? Go up a little bit here, maybe hit the downtrend line and then fail to breach it and come down a little bit and then create a double bottom. All that is very possible. Okay, just the way technicals work. McClellan oscillator is creating a positive divergence, and you can see that here. This was the lowest end of the McClellan oscillator. Anytime it gets towards -200, you really got to buy with both hands down. That's just my opinion. That's what I've seen. Every single time that's happened. So look at this. This was a positive divergence because we came down pretty much to the same levels, but look what the McClellan oscillators were. Here it was -191. Here it was only -32. That shows positive divergence as smart money or whatever it is starts to basically they're accumulating as the margin cells are going through. When you take out Disney and Viacom and shoot them out in the backyard and Mickey's basically left homeless, I'll tell you, that's not that value fund managers cringe at that type of thing here. And Apple too. So they obviously scooped up some, some nice amount of stock. So that's really what's going on here overall in the market. I am going to put this up right now. Let's engage, and I'll be more diligent in putting up the video cast. It's summertime, so you have to forgive me for managing my family time and doing it. So that's it. That's